Formulating corporate level strategy. We all know the results obtained through external and internal analysis provide the inputs needed by a firm to develop its strategic intent and strategic mission. Strategic intent shows how resources, capabilities, and core competencies will be leveraged to achieve desired results in a competitive environment. The mission is used to specify the product markets and customers a firm intends to serve through various strategies. In this lesson, we will describe the balanced scorecard, a balanced approach, explain the importance of grand strategies, strategic alternatives, discuss the growth or expansion strategy, and explain the diversification strategy. After going through this presentation, you should be able to explain meaning of corporate strategy formulation, the balanced scorecard, the growth or expansion strategy, the diversification strategy, the retrenchment strategy, and the combination strategy. The scorecard allows managers to evaluate a firm from different complementary perspectives. A firm can offer superior returns to stockholders if it has a competitive advantage in its product or service offerings when compared to its rivals. In order to sustain a competitive advantage, a firm must offer superior value to customers. This, in turn, requires development of operations with necessary capabilities. In order to develop the needed operational capabilities, a firm requires the services of employees having requisite skills, creativity, diversity, and motivations. Thus, the performance as assessed in one perspective supports performance in other areas such as financial perspective. Does the firm offer returns in excess of the total cost of capital as suggested by the economic value added EVA model? EVA is the spread between a firm's return on invested capital minus its weighted average cost of capital multiplied by the amount of capital invested. Customer's perspective. Does the firm provide the customer with superior value in terms of product differentiation, low cost, and quick response? Operations perspective. How effectively and efficiently do the core processes that produce customer value perform? Which are the most important sources of customer value which need improving to offer greater customer value? Organizational perspective. Can this firm adapt to changes in its environment? Is its workforce committed to share goals? Does the organization learn from past mistakes? When confronted with a problem, does it go to work on root causes or does it only scratch the surface? A properly constructed scorecard helps a firm strike a fine balance between short and long-term financial measures, financial and non-financial measures, internal and external performance perspectives. Grand strategy is the general plan of major action by which a firm intends to achieve its long-term goals. It provides basic direction for the strategic actions of a firm. Most firms begin their operations as single business units. Some firms continue to thrive due to their specialized operations and exclusive focus on a limited business arena. The firm could diversify into related or unrelated businesses. Of course, unrelated diversifications may result in uncertainties associated with losing touch with the fundamentals of each business and the difficulty of analyzing the numerous disaggregate external opportunities and threats inherent in unrelated industries. Wright et al. Managers have to be extremely cautious in choosing the various strategic alternatives aimed at improving customer value. Grand strategies fall into four general categories: growth or expansion, stability, retrenchment, and the combination. Organizations generally seek growth in sales, market share, or some other measure as a primary objective. When growth becomes a passion and organizations try to seek sizable growth, as against slow and steady growth, it takes the shape of an expansion strategy. The firm tries to redefine the business enter new businesses that are related or unrelated, or look at its product portfolio more intensely. There are certain inherent limits to corporate growth, and a firm intending to grow beyond a particular limit should look into the pros and cons carefully before embarking upon an ambitious growth strategy. When an organization achieves stability after a time, it can pursue growth strategies in the same field or in diversified fields depending on its strengths. Growth strategies are extremely popular because most managers tend to equate growth with success. Obviously, a firm that fails to move ahead may fall behind in the competitive race. The firm that operates in a dynamic environment must grow in order to survive. Growth implies greater sales and an opportunity to take advantage of the environmental opportunities. Growth, however, is not an unmixed blessing. In some firms, as pointed out previously, growth beyond an optimum limit creates many problems. Growth at a high rate and for an extended period makes a business exceedingly vulnerable. It makes it all but impossible to manage it properly. Even from the financial point of view, a growing company does not offer sound investment opportunities. The firm initially must set its growth targets both for the short term and long term. Growth requires internal preparation. The company should be able to strike a happy balance between risk and return on resources. It should be able to combine activities, products, and business in a useful manner. Diversification describes the number of different businesses that an organization is engaged in and the extent to which these businesses are related to one another. Diversification involves entry into fields where both products and markets are significantly different than those of a firm's initial base. Related diversification occurs when a firm expands into industries similar to its initial business in terms of at least one major function. When the firm enjoys distinctive competence such as marketing, distribution, engineering, etc. Unrelated diversification involves expansion into fields that do not share any financial or skill-based interrelationship with a firm's initial business. Diversification is said to minimize risk associated with confining the business to one or very few products. The company can enter new lines of business to preempt potential competitors or to gain superiority over competitors entering the market at an early stage. It can introduce new products satisfying a variety of needs. This helps in consolidating its position in the industry. Horizontal integration takes place when some firms expand by acquiring other companies in the same line of business. Conglomerate diversification takes place when an organization diversifies into areas that are unrelated to its current business. Diversification will be fruitful only when the benefits generated by diversification outweighs the related costs. When diversification is likely to produce fewer benefits than costs, the firm should turn its attention to restructuring its operations with a view to enhance shareholder value. A stability strategy involves maintaining the status quo or growing in a methodical but slow manner. The firm follows a safety-oriented status quo type strategy without affecting any major changes in its present operations. The resources are put on existing operations to achieve moderate incremental growth. If the company is doing reasonably well, managers may not like to take the risks or hassles associated with more aggressive growth. Stability allows the firms to stop for a while, re-examine what it has already done and proceed cautiously. An organization that has stretched its resources during a period of accelerated growth may want to attain stability before it attempts further accelerated growth. To maintain current position, the organization definitely needs to carry out marginal improvements in performance in line with changing trends. Introducing new products, entering new markets, undertaking major organizational changes all require huge investments. Where there is an internal resource constraint, a stability strategy is preferred. Retrenchment strategy is a corporate-level defensive strategy followed by a firm when its performance is disappointing or when its survival is at stake for a variety of reasons. Economic recessions, production inefficiencies, and innovative breakthroughs by competitors are only three causes. Retrenchment calls for a radical surgery to cut the extra fat, say laying off employees, dropping items from a production line, eliminating low-margin customer groups, avoiding elaborate promotional efforts, etc. A leveraged buyout occurs when a company's shareholders are bought out, hence buyout, by the company's management and other private investors using borrowed funds, hence leveraged. In the last case, the parent company creates a new company and then distributes its shares to shareholders of the parent. Reasons for divestment are strong focus, unlock critical funds, invest in emerging technologies, a maker of policy from red to black, and unviable projects. A turnaround is designed to reverse a negative trend and bring the organization back to normal health and profitability. The basic purpose of a turnaround is to transform the corporation into a leaner and more efficient firm. It usually involves getting rid of unprofitable products, trimming the workforce, pruning distribution outlets, and finding other useful ways of making the organization more efficient. If the turnaround is successful, the organization may then focus on growth strategy. Firms often lose their grip over markets due to various internal and external factors. If they have to survive and flourish in a competitive environment, they have to identify the danger signals quite early and undertake rectification steps immediately. The action plans for achieving a turnaround aim at yielding immediate results, focusing attention on certain key areas like quality improvement, cost reduction, new product development, rejuvenated marketing effort, etc. Large, diversified organizations generally use a mixture of stability, expansion, or retrenchment strategies either simultaneously. In recent times, three or more strategies have gained popularity, namely joint ventures, strategic alliances, and consortia. When two or more firms pool resources to accomplish a task that a firm could not accomplish or that can be done more effectively by joining, the result is a joint venture. Like a merger or acquisition, a joint venture is not a strategy but a way of implementing a strategy. It helps a firm to undertake giant projects by spreading risks more efficiently. In a joint venture, the companies involved take an equity stake in one another. In strategic alliances, however, the partners contribute their skills and expertise to a cooperatively conceived and executed project for a specific period. Partners during the said period try to peep into each other's know-how and learn from one another. Consortia are interlocking relationships between businesses of an industry. It works more or less like a Japanese keiretsu, involving up to 50 different firms that are joined around a large trading company or bank and are coordinated through interlocking directories and stock exchanges. Corporate restructuring is one of the most complex and fundamental phenomena that management confronts. Each company has two opposite strategies from which to choose to diversify or to refocus on its core business. Corporate restructuring is an episodic exercise not related to investments in new plant and machinery which involve a significant change in one or more of the following, such as pattern of ownership and control, composition of liability, and asset mix of the firm. It involves significant reorientation, reorganization, or realignment of assets and liabilities of the organization through conscious management action to improve future cash flow stream and to make more profitable and efficient. It is a comprehensive process by which a company can consolidate its business operation and strengthen its position for achieving the desired objectives, synergetic, competitive, and successful. Corporate restructuring is the process of redesigning one or more aspects of a company. The process of reorganizing a company may be implemented due to a number of different factors, such as positioning the company to be more competitive, survive a currently adverse economic climate, or poise the corporation to move in an entirely new direction. Corporate restructuring entails a range of activities including financial restructuring and organization restructuring. Financial restructuring is the reorganization of the financial assets and liabilities of a corporation in order to create the most beneficial financial environment for the company. In organizational restructuring, the focus is on management and internal corporate governance structures. The perspective of organizational restructuring may be different for the employees. When a company goes for the organizational restructuring, it often leads to reducing the manpower, and hence meaning that people are losing their jobs. Now let us check if we have understood the various concepts discussed in this lesson clearly. Corporate strategy is basically concerned with the choice of businesses, products, and markets. Right or wrong? Right. The scorecard allows managers to evaluate a firm from different complementary perspectives. Right or wrong? Right. Concentric diversification takes place when an organization diversifies into areas that are unrelated to its current business. Right or wrong? Wrong. Before we end, let us briefly revise what we have studied till so far. Corporate level strategy involves determining in what business or businesses the firm expects to compete. For companies with a single market or a few closely related markets, the corporate level strategy involves developing an overall strategy. Most large corporations, however, have complicated organizational structures with standalone, often unrelated business units or divisions, each with different products, markets, and competitors. Product development involves the substantial modification of existing products or the creation of new but related products that can be marketed to current customers through established channels. Stability strategy involves maintaining the status quo or growing in a methodical but slow manner. Retrenchment strategy is a defensive strategy adopted as a reaction to operational problems such as internal mismanagement, surprises caused by competitors, changing market conditions, etc., involving reduction of any existing product or service line to improve its performance. Turnover strategy. A turnaround strategy is designed to reverse a negative trend and bring the organization back to normal health and profitability. Combination strategy is a mixture of stability, expansion, or retrenchment strategies applied simultaneously or sequentially. The corporate level strategy then involves making decisions on whether to add divisions and product lines to manage the business portfolio of businesses. Corporations are responsible for creating value through their businesses.